inflation, multiples will start coming down everywhere. So despite early recovery, you may not see that much return in the market or in some of the stocks if the worries about inflation start coming back.
Okay, by the way, the IT stocks are sitting at fresh 52-week highs. TCS ahead of its numbers on Fridays at a fresh high. But HCL Tech, Wipro, Infosys are not too far behind. So all these stocks sitting at fresh highs as we speak. Sanjeev, another stock I wanted to ask you about was Aurobindo Pharma. I mean, of course, you may not want to comment on individual stocks, but some of these companies like Aurobindo Pharma, Lupin could be big beneficiaries of the PLI scheme in the pharma space, and that's what a lot of brokerages are betting on as well. From these levels, do you see incremental gains in some of these names?
So we like the pharma names in general for various reasons. Some of them have fairly strong domestic businesses, and most of them, if you look at all the way till FY24, FY25, have a fairly strong pipeline as far as the generics pipeline is concerned. So we are looking at fairly strong earnings growth for all the pharma companies which we track all the way to 24, 25, in fact. And multiples are not very, very high over here. I mean, they have also expanded. If you look at pharma multiples, same way, if I look at 1 year back on March 22 basis, they were trading at about more like 17 to 20 times, or like 15 to 20 times. Now they are up to somewhere about, more like 70 to 24 times also in the case of Torrent. So yes, multiples have expanded. But at least the revenue visibility seems to be fairly strong over here. And if you see any additional revenues coming in from what you mentioned about PLI scheme, that's again a positive. You can see the multiples of DB. That's obviously one of the biggest players as far as outsourcing is concerned. And anyway, that's been a company that has benefited significantly from that. We are looking at fairly strong earnings recovery over there. 37% this year, 21% next year, 30% FY23. So that will continue. Just that valuations have become fairly expensive for our DPs now.
Would you go for any of the value pockets, Sanjeev? Let us start with the finance space. Would you go to PSUs, PSU banks as a trading pick at least, or any of the NBFCs, any part?
No, we like some of the NBFCs. In fact, I've had them in the mid-cap portfolio for some time. They have rallied pretty hard in the months of October, November, and December. But having said that, valuation is still quite okay for most of the names over here. Chola, which has now gone to somewhere about 3 times on March 23 basis. Rest all are still quite inexpensive, at least on a March 22 or March 23 price to book basis.
And PSU banks?
So far, the data, I'll come to that in a second.
Yeah.
So far, the data seems to be fairly okay in terms of collection efficiency. To look at mortgage finance companies, collection efficiency data has actually gone back to pre-COVID levels. Same way for vehicle finance companies creeping up to pre-COVID levels. So it looks all okay over there. And whatever concerns we have had on the MSME loans, etc., that doesn't seem to be as bad as what the worry was, let's say, in March, April timeframe.
Okay.
PSU banks, again, the valuation is very cheap. SBI is something which we have liked for some time. Even after the rally which we have seen in SBI, it is still trading at about 0.7, 0.8 times, just with the value of all the underlying subsidiaries, which are anyway doing very well. So yeah, you still have a fair amount of value in the, I would say, the PSU banks and NBFCs. Here the question, Lata, is, if the economic recovery continues and concerns about credit costs and NPLs start fading or reducing, I would assume you will see, some more rating in multiples of the PSU banks and NBFCs.
Got that. By the way, the market's recovering, and the recovery is now courtesy the bank Nifty actually. Just pull out the intraday chart of Axis Bank. That's the one which is leading it. And Axis and ICICI Bank normally move in tandem, the corporate banks. So both these stocks are now beginning to move up. Look at that move on Axis. That's seen a sharp traction. I think even ICICI should follow. That's in the red now, but won't be surprised if this momentum carries it in the green as well. And mid caps have also recovered. Sanjeev, are you tracking the move in the real estate space? Because some of the stocks have started to show real good traction. Is there a good risk-reward equation here for investors?
See, the stocks have all rallied. We have like DLF, Prestige, Brigade, etc. So most of these stocks are now trading pretty much in line with our fair value. So the upside may be somewhat limited. Now we'll have to wait and see, how sustainable is the recovery that we have seen over the past few months. At least as of now, recovery looks fairly strong based on various factors. The inflation rate is pretty low. That itself results in EMIs being significantly lower. If I look at, let's say, the EMI on a certain amount of money and a certain amount of loan in March 16 year versus now, that's about 20% down. So obviously that itself is a bit positive. And I guess there is a lot of pent-up demand, people looking for better houses, one room extra, given this whole work from home issue and so on and so forth. So the pent-up demand story looks very good, and we have had some catalysts in the form of lower stamp duty in the state of Maharashtra at least. So all that resulting in fairly significant economic recovery in real estate volumes. How sustainable is that? We'll have to wait and see. But having said that, again, the stock prices are all discounting a lot of good news. That's the real challenge across sectors now. The risk-reward balance is not as favorable as it was, let's say, 6 months back. Margin of safety is a lot lower. So now the question is whether the recovery that we are seeing, surprising upside, earnings upgrade, take this not. We'll have to wait and see. Otherwise, a lot of good news is already getting priced in.
Okay, so do you fear that despite an earnings upside, you spoke about the Nifty FY22 EPS growing by 28%. Do you think a lot of that is already priced into the market? Just trying to understand, what is your calendar year-end target on the Nifty?
Well, I don't bother putting all this, fancy target prices. Nobody seems to know anyway. I think the way you look at it is, do you have sufficient comfort as far as your multiples are concerned? The answer is no at this point in time. After we're saying, we're already at about 22 times March 22 P as far as Nifty is concerned. That is clearly on the higher side, so, and that is based on the 28% growth, which I was anyway talking about earlier. So my best sense would be, assuming multiples don't derate, or if they derate a little bit, you probably end up making high single-digit returns this year, given the fact that the starting point in terms of valuations is fairly high. If you're starting with a 22P, you don't really expect the multiples to expand further from where you are.